to Global Market Outlook 2016, a special series that we bring to you each year from the City of London, talking to a lot of prominent fund managers and market speakers about their outlook into the new year. Joining me on the show today is Bill Street, who's the CIO of EMEA at State Street Global Advisors, an asset management company which has close to $2.2 trillion under assets. It's one of the largest AMCs in the world. Bill, it's great to have you on the show. Thanks very much for taking out the time. How are you viewing 2016? 2015, as I've been asking my guests, has been very patchy. When we started off 2015, there was an expectation that we would see clear signs of recovery and pickup in growth. That hasn't happened. In fact, there have been multiple revisions downwards to global growth. Do you think that 2016 perhaps would come with more stabilization for world markets?
Yeah, I think 2015 had a number of events, unexpected events and challenges that were peppered throughout the year. Not only China, but some of the Greece crisis, and there was a lot of shocks to the marketplace that shocked investors and their assumptions on value and places to invest. I think as we look forward to 2016, unfortunately I don't think growth is going to be significantly better. We do see pockets of improvement, but I think it's a year of stabilization and long and low growth. So investors need to look at how they navigate through that, and part of that long growth and low returns is going to be peppered with much higher volatility. If you look back in 2015 in August, at the end of August, we had a spike of the VIX up to 54%. That's the highest spike in the VIX since 2009. And so we have to be wary of how we manage the volatility and returns and ensure we get good risk-adjusted returns to our clients.
Right, so which is your preferred asset class for 2016? Because if you're saying that growth is going to be low, which means that there would be perhaps a lag in corporate earnings, which is a key driver for equities. On the other hand, with the bond markets, if a normalization doesn't pretty much play out as one expects from the Federal Reserve, and there is a more accommodative stance from other central bankers, then you do not expect much way by way of movement on the yields as well. So where will where will there be an opportunity to make money?
Yes, I mean, when you look at 2016, we are looking at a period of low growth and low returns. However, there will be pockets of opportunity within that. And if you look at the equity markets, as you touched on, within the developed worlds, there are definitely a number of tailwinds. We'll look at asset classes like European equities that will have positive impulses from not only monetary policy, because we're seeing the ECB going to be stepping back into the game and probably far more aggressive than they have been in the past in Q4 and Q1. We've also got a significant reduction in the value of the euro, which is going to be a great impulse to GDP, and also the oil price. So if you look at the impact of the euro, you can have up to 0.5% of GDP effect by a shift in the trade-weighted index of the euro. And that's going to be significant in the region. So I think European equities are looking good, especially to its counterpart in the US, where you have seen a trail off of earnings recently. We don't know if that's going to be a sustained taper of earnings, but there are significant potential headwinds with policy coming in. So it's quite clear the Fed have an agenda on policy, and it's yet to be seen how much of a headwind that has on growth or corporate earnings in 2016.
Markets take that as a cue that the US economy is on a strong footing. If they actually go ahead with a fairly aggressive normalization process, as you suggest, over 2016, or would the market still be wary because the rest of the world would still be easing, and global growth, the signs of that picking up would not be clear?
I would say the market is expecting the rate hikes because of the expectations being managed by the Fed, rather than the market being fully bought into the underlying fundamentals. The bottom line is there's no smoking gun with regards to inflation. And so when you have unemployment coming down, but core inflation and wage inflation coming down at the same time, it's difficult to argue a strong case for the need of rate hikes. However, there's obviously a motivation to have some sort of normalization of interest rates. If you look at what that will do to the broader economy, you can just look at the bond market. I expect the bond curve to flatten post a rate hike, which would suggest that the market presumes that will put a headwind on growth going forward.
And what would that really mean for opportunities outside of the US? Because if you are looking at a process of normalization by the Federal Reserve, then one would perhaps look at more capital flowing into the US markets. One would also see the dollar perhaps gaining more traction, which has either ways been a key performer in 2015. So would there be much to do in terms of investment ideas outside of the US?
Economies that have exposures to a strong dollar will not necessarily be a benefit, but those, especially the emerging markets that have less exposure to the strong dollar, will benefit, such as the exporters.
So do you believe that the bias for 2016 will be towards developed economies, Europe coming out, stabilizing from the lows of the economic cycle, and the US taking the next leg of growth with some support coming in from the Federal Reserve in terms of, of giving the signal to the market that things are looking strong internally for the US economy, and that perhaps will just keep the bias with the developed economies versus emerging economies, which have had either ways a very tough year?
Yeah, so I think Europe will have growth. Looks like it will continue to have a decent amount of growth, at least relative to its low absolute level at the moment. I think we will struggle to see significant growth out of the US, but that's okay because they are changing interest rates. I think the emerging markets is going to be an interesting one. They've had such a difficult year in 2015. I think it's a year of stabilisation. But I think what is interesting about the emerging markets, it's really going to be a year where the reformers will perform. And that means that the reforming markets within the emerging markets, or the reforming countries that have spent the last few years reforming economic policy, reforming their debt dynamics, less exposure to hard currency debt, more exposure to local currency debt, will be the real beneficiaries. And then also you have the split, the dichotomy between the commodity-driven emerging markets and the import-driven emerging markets as well.
So it's going to be a year where it's going to be each EM for itself, a very differentiated performance in emerging economies and emerging markets. In that light, which are the ones that you think would stand out, both as reformers as also commodity consumers, having both those benefits coming towards them, and the ones which will perhaps lag?
Yes, no, definitely. So to your point, I don't think it's just a pure beta play across the emerging markets. I think we need to be a little bit more forensic about how we take our investment decisions in the emerging markets. To the point, reformers will be the performers, and that has been laid out, whether it's social reform, political reform, or economic reform. To your question, I think at a high level, you'll be glad to hear one of our darlings of EM will be India. And I think some of the countries that will continue to struggle will be the commodity countries. You've seen significant challenges in Russia and places like Brazil. So I think that will continue. I think they'll stabilize. The Russian and the Brazils will stabilize in 2016, but it'll be difficult for them to improve or perform very strongly in 2016, especially if we have commodity prices staying where they are.
And do you expect commodity prices to stay where they are, or is there likely to be a bounce back purely on technical terms?
I think if you look at the commodity prices, it's had a sort of a perfect storm. It's had a demand shock, as you've seen China slow down in its growth dynamics, and we have China slowing down even further in 2016. So that's not a great picture. We've also had this supply type shock as well, where you've had this overhang of inventory from OPEC as well. So I think there's enough there to keep the oil price muted. So we're not looking for an aggressive pickup in the oil price, but I think it's fair to say the majority of the correction is done.
It's interesting that you pointed out India, because when I was talking about your points on reformers performing in 2016 as also commodity consumers being key beneficiaries, we've seen part of that story already play out for India this year. Do you think it's going to be a continuation from how 2015 wraps up for the region?
Yes, I think Modi's reforms will continue. I mean, obviously reforms take time to hit the real economy, but I think they'll continue to have an impact on the economy. And I think also, as stated, things like the currency, its exposure to hard and soft debt is important. Soft currency debt is very important going forward. And it's going to be a natural beneficiary of these low commodity prices as well. Yeah, I think in terms of how people are investing in their portfolios, I think people are still going to be looking at the risky assets. The low return growth environments is still going to drive investors into the sort of tail of risky returns.
In terms of just pure allocations, given the size of State Street Global Advisors, are you going to be looking to increase allocations to India?
I think in terms of the EM complex, I think it's fair to say that India will be one of the performers going forward. So at any point in time when we're looking at value and price, we would be looking at India to be one of the performing stars in 2016. But you have to take that in the context of the price points. India's a favoured market at the moment, so you have to look at it against its valuation point. But we would be looking at any sort of discount in price, looking to see if that's good value for our portfolios. But the fundamentals as they stand today are very positive for India going forward.
Is that your top market in emerging markets?
I think it's one of the top. I think the emerging markets are going to be very differentiated with all these dynamics going in the markets at the moment. I think also the other thing is we have to be very cognizant of is there's a lot of downside risk in investment management or our portfolios going forward in 2016 across whether it be emerging markets or developed markets. We saw as we mentioned about the volatility on the VIX, that came out of nowhere. We potentially got.
What about a potential default in emerging markets? As you pointed out, there is the concern of debt. Some countries are very highly leveraged, especially the commodity producers, and that derive value from the commodity business. Also, the fact that a lot of countries have high foreign-denominated debt to GDP, and so a couple of them may perhaps not be able to, in lieu of cash flows not adding up, be able to make payments on their dues. Is there a risk? Is there a systemic risk in the offing on account of that?
I wouldn't say there's a systemic risk in 2016 to have a big emerging market debt blowout. I think the debt dynamics in the emerging markets are better than they have been since the previous emerging market crises. But definitely, as you look at the emerging market spreads already, they are sort of embedding a risk premium for those countries definitely that are going to struggle with the commodity prices and the dollar repayments if they're based in hard currency. So that is definitely going to be a challenge. But there are a number of volatility events coming down the channel which will hit the emerging market and the developed markets. We still have a lot of geopolitical risks. We still don't have complete transparency of some of the dynamics in China. Best guess they're going to grow at about 6% next year, and China is a big sort of epicenter of concern for the emerging market. So we have.
What's your view on China? Because that's been, like you said, the key risk for this year. Does it continue to be a key risk, or do you think the market perhaps is more aware of what's happening in China because of the announcements that came by this year? And so they would be able to adjust accordingly to the slowdown or perhaps the pressure that the economy is facing in 2016.
Yes, look, I mean, when you look at China, there is a certain opaque nature of the data that comes out, which always makes us a little bit cautious when we're analysing the data. But we do think that if you look at the dynamics going on in the real economy, that the growth rate will continue to slow in 2016. But the problem is that China sneezes and everyone else gets a cold, and that is the problem. I would also say that China is probably best placed to correct some of their sort of failings or correct some of their growth paths if they want to. So they're in this longer term transition between an investment to a consumer-led economy. China has the ability to step in and do more reinvestment in the economy and sort of glide that growth path more easily. So it's in the hands of the policymakers. I don't think the policymakers are going to be very keen on having a repeat of the type of volatility on the Chinese stock market we saw this year. So I think they're going to be very cognizant of trying to manage that growth path in 2016.
But wouldn't it be a year where China's position as an economic power, as also its position on the global political stage, would change if the yuan enters the SDR CR. To that extent, given that Chinese investments this year outside of China have increased considerably, there is much focus on, just scaling up the dominance of the country on the global map.
Yeah, I think there's going to be one of the things that China is slowly doing is liberalising and opening up their capital markets. And I think as you see that happening and you have greater sort of international and overseas investment and liberalisation of that market, you'll get a lot more stabilisation in the capital markets. And I think some of that volatility over time will come out. That's not going to be purely a 2016 story. That's going to be a multiple year story.
Okay, so if you were to look at, money flows for 2016, there was a big sell-off in commodities, there was a big sell-off in emerging markets. A lot of safe haven assets were bought into, especially the dollar in 2015. How will money flow patterns play out for 2016?
Yeah, I think in terms of how people are investing in their portfolios, I think people are still going to be looking at the risky assets. The low return growth environment is still going to drive investors into the sort of tail of risky returns. There's some markets that are looking quite attractive, even parts of the fixed income market and the high yield market look good. If you look at some of the spreads in the US high yield market, they've been dominated by some of the volatility in the energy sector. But if you look at the sort of implied default rates that are coming out of the high yield market in the US, looks like quite a good compelling argument to invest in that. I would also say, going back to the risky markets in Europe as well, high yield equities look like they'll be good performers in 2016.
And from India, you think it's going to be the equity markets, or there's going to be much interest in the credit markets, in the bond markets in India as well? Given that the currency has been largely resilient, it's pretty much moved in a range. Mm-hmm. So you may not have the bias of a weaker currency as an investor, but you would have the benefit of a stable currency for one's returns.
Yeah, I think when you look at emerging market debt or emerging market investing, you do get a lot of the volatility or your returns driven out of the currency. So one thing that India does have, as you pointed out, is out of the emerging market complex, it's had a more stable currency. But when you're looking at credit and debt, you have to look at it in the context of the global credit market, and there's a lot of opportunities coming out of the developed world in itself. So there's a relative play there on the risk premiums driven from emerging market credit or even emerging market sovereigns to things like the high yield space.
But wouldn't that also mean that for India, exporters, especially to Europe and the US, will be a clean and a clear area where one would look at an investment opportunity?
Yeah, I mean, India is a good place to invest in 2016. It has that stable currency. It has some good fundamental dynamics behind it. But in a balanced portfolio, or a portfolio of balanced investments, I think that would be a good choice to sit alongside some of the more developed positions.
Okay, so as we wrap up the interview, Bill, I just want to get your broad summary on whether you're more optimistic about 2016 or you're cautiously optimistic, or perhaps you believe that there are, very measured opportunities, but better opportunities than in 2015 for the new year.
I think that ultimately I'm cautiously optimistic. There's definitely pockets of opportunity. I think one thing you can be sure of, at the end of 2016, when you look back, there will be significant events of volatility. Now, volatility in itself, one has to navigate, but volatility provides opportunity. So as we see volatility hit the marketplace, you'll get a dispersion of returns, a dispersion of valuations, and you need a good investment manager to be able to navigate and take those opportunities into your portfolio.
All right, Bill, we leave it at that. Thanks very much for taking out the time to speak with us. With that, we come to the end of this edition of Global Market Outlook for 2016. Catch you with another special guest next week. Till then, take care.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.